Let's talk global liquidity because global liquidity is really the key driver behind asset prices. When global liquidity is rising, we typically see our favorite assets like Bitcoin or stocks rising with it. And when global liquidity is falling, we typically see these assets falling in price. In this video, we're going to be looking at where global liquidity has been over the past couple of years and where global liquidity is going and its impact on different assets. Before we do get into the video, please make sure to like the video and also subscribe to the YouTube. Really appreciate your support. I'm also going to put a QR code down below for a Bitcoin tip. So if you want to support the channel, feel free to leave me a little tip. Now let's get into it. Global liquidity has been constricted since early 2022. And the reason that global liquidity has been constricted is because we got all of this inflation following the COVID pandemic. When we got hit with COVID, we all got those stimulus checks. You remember them. We saw businesses get this stimulus, and the government basically provided all this life support to the economy. And in order to dish out all of this stimulus to the people, trillions of dollars worth of stimulus, the government needed to add a good chunk of debt to its national debt. And who came in and bought that debt? The Federal Reserve. And this is what we call quantitative easing. When the Federal Reserve comes in and buys debt, what do? They create new money, new monetary units, and they push those units out into the economy, and they take that debt and they hold it on their balance sheet. And this process leads to inflation, especially when you do quantitative easing to the amount that they did in 2020. Let's go ahead and take a look at a chart here, which shows the Fed balance sheet over the past, looks like 25 years here. And as you can see, in 2020, what happened to the Fed balance sheet? It shot up, and that's because of all that quantitative easing. They took all these treasuries out of the market and put them on their balance sheet. So this led to massive inflation. We also saw that the Fed dropped the federal funds rate to 0 in order to take pressure off the economy. So because the economy was slowing, because businesses were shutting down, they lowered their policy rate to incentivize more borrowing, to incentivize business, to basically make it easier for businesses and individuals to keep borrowing money. So as you can see in this chart, we saw in 2020 that the federal funds rate went down to 0. But the problem with this response is it created massive inflation. And we really start to see that after a couple of years. I think we really started to see it in asset prices. We saw the stock market crashing, and we saw other assets crashing in March of 2020. And then when we got hit with this relief, all of this added liquidity, we saw asset prices rip. We saw the stock market go on a crazy run. I remember Tesla was up a crazy amount. We saw Bitcoin and these cryptocurrencies really take off. And really in 2020, I think this is when a lot of people got put on notice about Bitcoin because it went on such a crazy rally all the way up to 69K, I believe. And the government realized after this that maybe they made a mistake, right? After a couple of years, we saw all this inflation really start to hit in all these different places around the economy, not just asset prices. And the government and the Fed realized that they needed to tighten their monetary policy. They needed to take some of this liquidity that they added into the economy out of the economy. So in early 2022, we saw the Fed start to tighten their monetary policy in order to combat this inflation. If we look back at this chart of the Fed balance sheet, we can see that the Fed balance sheet started to fall in 2022. So that means that they were selling these assets back into the market and taking money out, right? Taking liquidity out. And we could also look at a chart of the federal funds rate again, and as you can see in 2022, the federal funds rate started to rise, and it started to rise very rapidly. And this made it more difficult to borrow. It led to tighter lending conditions. And the combination of this fast rate hike increase from the Fed, along with the quantitative tightening, where they're lowering their balance sheet and taking liquidity out of the market, this led to a decrease in the money supply. Let's go ahead and take a look at a chart of the M2 money supply here. And as you can see, around 2020, the M2 money supply increased with all that quantitative easing. And then in early 2022, we started to see the M2 money supply dip. And if you're not familiar with the M2 money supply is basically a good measurement of the broad money out there, or really we should say the broad credit. So with the money supply, there is the base money, which I believe is somewhere around like $6 to $7 trillion. And then there's all this broad money, this extended credit that is built off of the base money. When you go to the bank and you deposit a check for $1,000, what does the bank do? They take that check and they lend it out to someone else. And then that person has $1,000, and then that person deposits it into their bank account, and then their bank takes that $1,000 and they lend it out to someone else. So from this one deposit, we see all these different deposits end up in all these different banks, right? And this is what we call the money multiplier effect. So really, we see credit expand a lot from a single deposit, and we measure all this extended credit with the M2 money supply. When credit conditions tighten, right? When it's more difficult to lend, when interest rates are higher, we see less lending. And because of that, that leads to the M2 money supply falling. So as we can see in the chart, the M2 money supply started to fall in early 2022. And if you look at the end of the chart, we're starting to see it tick back up, but we really haven't seen the M2 money supply take off yet. But I think it's going to, and I'm going to get into that in a couple of minutes here. Let's go ahead and take a look at a couple of other charts here. These charts show the correlation of the S&P 500 as well as Bitcoin to the M2 money supply. Let's go ahead and take a look at the chart of the S&P 500's correlation first. And as you can see, the S&P 500 has pretty closely followed liquidity over the past 10 to 12 years here. The blue line is the S&P 500 and the orange line is the global M2. If we go ahead and take a look at a chart of Bitcoin, we can see it's pretty much the same. The blue line is Bitcoin, the orange line is global M2. As the global M2 is rising, we see Bitcoin rise, and when we saw the global M2 dip in early 2022, that's when we saw that big dip in the Bitcoin price. So assets typically move with global liquidity, and this is something that we always need to keep in mind. It's really easy to look at the performance of a company and think, wow, their earnings are so good, the company's growing, the stock's obviously going to shoot up. But if we're entering a period where liquidity is contracting, that might not be the case. So global liquidity is very important when we look at the dollar value of these different assets. Now, there is some good news for Bitcoin and stocks. Over the past couple of years, we really haven't seen liquidity rising that much, and we have seen these assets performing very well. Bitcoin actually just today broke back above 100K, and the stock market has performed very well up until the last couple of months here with all of this tariff drama. And that just makes you think, if these assets are performing this well when liquidity isn't growing that much, what's going to happen when liquidity really takes off? And liquidity is going to take off. The reason that liquidity will take off is because of the debt-based system that we live in, this credit-based system where everyone takes out debt for everything. People take out a loan to start a business or expand a business. People take out a loan to go to college. They take out a loan to buy a house. They take out a loan to buy something smaller like a car. And when liquidity is rising, we see this liquidity flow into these different assets, into these different investments, and it pushes the price up. And people are able to profit, they're able to pay off their debts, they're able to make their interest payments. But when liquidity is falling, when dollars are leaving from the system, we typically see assets and investments priced lower. And as it comes time for people to pay off these debts, right, to make their interest payments or to pay off their loans, and their investment has gone down in dollar terms, they don't have the money and they default on these loans. And when people start to default on their loans, there is all this counterparty risk out there. Not only does the entity who took out the loan take a loss, but the lender takes a big loss. And the lenders are typically the banks. And when the banks start to take losses, they start to run into trouble, right? And when the banks run into trouble, that is not good for the whole fiat credit-based system. So the system really needs to continue expanding in order for people to pay off their debts. And in order for the game to keep going, the liquidity needs to keep rising. And that's good news for asset prices, in particular Bitcoin. We have seen consequences from the constricted liquidity over the past couple of years. If you remember, a couple of years ago, we saw two of the largest bank failures that we've ever seen in US history, with the fall of Silicon Valley Bank and First Republic Bank. Last year, we saw a lot of signs that the economy was weakening, or at least parts of it, with all these bankruptcies and all these layoffs. And it's clear that these tighter financial conditions are taking their toll on different parts of the economy. The Fed realized this and started to cut the federal funds rate in 2024. In September of last year, we saw the Fed cut 50 basis points. In November, we saw a 25 basis point cut. And in December of last year, we saw another 25 basis point cut. So they cut 100 basis points last year, 1% from the federal funds rate. And things were looking good for the markets. We had Trump coming in and the markets were pumped about that. We saw the Fed starting to cut rates and everyone was feeling pretty good. And then we get to this year, and so far we have no rate cuts. We've had these tariffs, which have also constricted global liquidity, and I'm going to get into how they've done that in a sec. And it has not been great for asset prices in the short term. And the thing about cutting rates for the Fed is if they do cut rates more, we are going to see liquidity rise and we could see inflation take back off. And that's not what they want. They have kind of lost control of the markets. Really, I don't think that these Fed fund rates decisions are having that much of an impact on the markets anymore. I think that the markets are more responding to QE and what's happening at the fiscal level with these deficits, but they are hesitant to lower the federal funds rate more because it is going to lead to inflation ticking up, and it's actually going to lead to interest rates heading higher, because as inflation heads up, lenders are going to require a higher interest rate because they want to beat inflation. The US isn't the only one who started cutting rates. We saw the European Central Bank start to cut rates in June of last year, and they actually just cut rates in April. They cut their deposit facility rate down to 2.25%. That's the seventh cut since they started cutting. And we know that Europe's economies were kind of struggling with these higher rates, with tighter monetary policy. So I think that the ECB is just looking to take a little bit of pressure off of the economies there. We also know that these US tariffs have taken a toll on some of these exporter nations in Europe, countries like Germany, Italy, and France. So we will see what happens with their deposit facility rate, but they have definitely lowered it a good amount, and they have lowered more aggressively than the Fed. If we look at China, China started to cut rates in 2024, and I believe in 2023 as well. China has been dealing with some issues. We know that China went through a real estate crisis with the collapse of one of their largest property developers in Evergrande, and we know that some of their other large property developers have gone through similar issues with having trouble covering their debts. We know that China is dealing with a bit of a population crisis as their working generation is growing old and they don't really have a younger generation that can replace them. And we also know that these tariffs are taking their toll on China. As we know, China is the world's factory and they're reliant upon importing to the US. Now the US and China have a bit of a trade war going on, and this is having a heavy impact on them. So we will see what happens with China's monetary policy, but they have started to lower some of their rates there in China. We also know that China is an exporter nation and they like having a weaker currency. So as we saw the Fed start to cut rates last year, we saw China adjust by cutting some of their key rates. We've also seen that China's M2 money supply has continued to grow. It's currently at 40.1 trillion when we value it in US dollars. If we look at the Eurozone's M2 money supply, that has continued to grow. It's valued at 16.5 trillion US dollars. And then the M2 money supply for the United States, it looks like it is around 21 to 22 trillion dollars. So we are seeing global money supplies continue to grow. We're seeing liquidity start to rise up after a period where liquidity was being constricted. And the question is, when is this really going to take off? Now let's talk about tariffs, because these tariffs are having a significant impact on global liquidity. As we know, the US dollar is the world reserve currency, and the rest of the world uses the dollar for a lot. They use the dollar to settle trade. We typically see the dollar accepted as a means of payment all around the world. And in order for the US dollar to be the world reserve currency, the world needs a lot of dollars. So the question is, how does the world get all these dollars? They get these dollars through trade with the United States and through the US running a massive trade deficit. So when the US imports from other countries around the world, the US takes in their good or service or their input, and then the US exports the dollar to that foreign entity, right? And dollars go out into the rest of the world. And from the US running this massive trade deficit, constantly importing goods and services, it allows them to flush all of these dollars out to the rest of the world. But tariffs, what is a tariff? A tariff is basically a tax on imports, right? Tariffs are put in place to de-incentivize importing. So with these tariffs, the idea is for the US to produce more at home and become less reliant on importing from other countries. And if you do want to import, it's going to be more expensive. So this should lead to the US probably importing less from other countries. And when they're importing less, that means that they're exporting less dollars out to the rest of the world. And that is a problem for a world that has become reliant on dollars. According to Lynn Alden, there is $61 trillion worth of dollar-denominated assets being held by foreign entities outside of the US, and there's $18 trillion worth of dollar-denominated debt being held by foreign entities outside of the US. So these foreign entities that hold all of these US assets have a lot of leverage over the US. And if the US is going to starve the world of dollars, then these foreign entities are going to sell their US assets to pay off their dollar-denominated debt. So that's not a situation that the US wants, and we saw the consequences of the US starving the world of liquidity in early April as stocks and bonds were crashing at the same time. Not a situation that the USA wants. And the Trump administration had to come in and do this tariff pause to basically provide some relief to the rest of the world and the United States and really take some pressure off of the bond market. So I don't really know if the US is going to be able to maintain these high tariffs, because it's going to starve the world of liquidity and they're going to sell their US assets, and that's not a situation that the US wants. The US needs to continue to provide liquidity to the rest of the world. They need to continue to run this trade deficit. And this is a major reason why I think this system is just kind of like screwed in the long term, right? It's going to lead to more debt for the US. It's going to lead to more inflation. And at some point, it's just all going to fall apart. Now, let's talk about how different assets respond to global liquidity. I showed you the charts earlier, which showed the correlation between the S&P 500 and global liquidity, as well as the correlation between Bitcoin and global liquidity. And as we saw in those charts, these asset classes are closely tied to global liquidity. When global liquidity is rising, we typically see these asset classes going up. When global liquidity is falling, we typically see these asset classes going down. And in Lynn Alden's recent May newsletter, she talked about how Bitcoin is a great barometer for global liquidity. And I've actually heard a lot of people talk about this. In her May newsletter, she mentioned that Bitcoin moves in the direction of global liquidity 83% of the time over any given 12-month period. And she talks about how Bitcoin is a great barometer for global liquidity. So really, when the Bitcoin price is going up, it's a sign that Bitcoin is maybe sniffing out that global liquidity is on the rise, and vice versa. When the Bitcoin price is going down, Bitcoin has been kind of a leading indicator. And the reason that Bitcoin is a great barometer for global liquidity is because it's a pure monetary asset, right? When we look at stocks, yes, they trade with global liquidity, and they have a very close correlation, but there are other things involved, right? Companies perform differently. They all have different earnings. Some are more successful over a given period of time compared to others. So because Bitcoin is this pure monetary asset, it's really good for measuring global liquidity. Now, when we look at gold, gold will typically rise when global liquidity is rising because the money supply is rising, right? And as the money supply rises and people see the money getting weaker, they want to hedge against that, and they will hide in an asset like gold, which has been a great store of value. Now, typically when liquidity is rising, gold will not go up to the same tune that stocks or Bitcoin will. Those assets are a little bit more volatile, or as some would say, a little bit more risk on, but we will typically see gold rise as the money supply is rising. Now, if we look at something like treasuries or treasury bonds, usually when liquidity is rising, it's not good for US treasuries, because when liquidity is rising and assets like stocks or Bitcoin are taking off, people are moving into those markets and they're leaving the bond market. They don't want to get paid a 4% interest payment when they can go in the stock market and earn a lot more. So typically, global liquidity going up means people leaving the bond market, which is not great for the United States. And that is one of the reasons why the Fed is so hesitant to lower rates and increase global liquidity, because they need to keep people buying US debt. They need to issue a lot of debt, and it looks like people are becoming disinterested. They need to get people interested in buying this debt to keep the game going. We will see how long the game goes. When liquidity is falling, people typically move away from riskier assets and into safe haven assets. So liquidity falling is not good for the stock market. Typically, when there's more liquidity out there, more money out there, people are pumping that money into the stock market. When liquidity is falling, people are taking that money out of the stock market. Maybe people are having trouble paying off their debts. It's putting pressure on businesses and just the whole working economy. So really, liquidity falling is just simply not great for the stock market. When we look at gold, when there is uncertainty out there, when liquidity is falling, yes, the money out there is falling, and that can, I guess you could say, could have a negative impact on gold. But because there is uncertainty out there, people are reallocating more to gold. They're going into a safe haven asset without counterparty risk. So typically when liquidity is falling, it can actually be kind of good for gold as people are seeking safety. And this has been the go-to asset for a very long time. Now, people have historically moved into bonds when liquidity is falling just to get paid that fixed income, right? To get paid that interest payment. But as the US national debt has continued to grow, and we've seen the supply of bonds continue to grow, it seems like people are really starting to lose faith in this market. And as we saw with this bond sell-off from tariffs, it's clear that maybe bonds aren't necessarily a safe haven asset, right? With all of this tariff drama going on, with the stock market crashing, the bond market fell with it. We saw foreign entities selling out of their US assets. And what's funny is a lot of people have thought of Bitcoin as a risky asset, but Bitcoin has performed pretty well over this past month as we've gone through all these ups and downs from tariffs. Bitcoin has been one of the best performing assets out there. I think gold has been the clear winner. Gold is up around $3,300 per ounce, but Bitcoin has held its own. And maybe part of the reason why it's done that is because Bitcoin really is a safe haven asset. It's not correlated to the rest of this bullshit that is going on out there, and it's its own separate system. As people sell out of US stocks, as people sell out of US bonds and their US assets, I think that some people were looking at Bitcoin as a place to hide along with gold. And really, Bitcoin is just, I mean, you could call it a risk asset, you could call it a safe haven asset. I would consider it more of a safe haven asset than a risk asset, but really it's just the best monetary asset out there, and it doesn't have counterparty risk. So when we see risk out there, I think people are going to lean more and more towards Bitcoin, and that is awesome to see. And you just think about what's going to happen when we really see this liquidity start to rise. What's going to happen when we see the Fed return to quantitative easing? What's going to happen when these tariffs probably get retracted, right? It seems like this tariff plan might not work out. We'll just have to see, but I don't think that the US can really starve the world of this global liquidity. It's clearly going to lead to some issues that the US can't have. To wrap up this video, I just want to re-emphasize that global liquidity will need to continue to rise. There's no way around it. If global liquidity does not continue rising, then debt will collapse and the credit-based system will collapse. So I think liquidity will continue to head higher. At some point, we will see a big jump in liquidity, and most assets are going to benefit. And I think the asset that will benefit the most is Bitcoin. That's going to wrap it up for this one. If you didn't like and subscribe, please make sure to do that now. Really appreciate your support. Thanks for watching. I'll be back soon.